In our strategy, we run a 5-phase macro framework. We focus on signals, sequencing, and probabilities, not headlines and not hype. This video claims China dumped hundreds of billions in U.S. Treasuries. The real question is not intent. It is what happens when marginal demand for duration weakens. We are reviewing the video titled, How China Just Dumped $800 billion in U.S. Debt. Our goal is to translate narrative into mechanics. This is not about politics. It is about yields, auctions, and balance sheets. That is where stress actually transmits. If a large foreign holder reduces treasury exposure, directionally that removes price-insensitive demand. That matters at the margin. But magnitude matters more than emotion. The treasury market is deep and still clears. So the question becomes, who replaces that demand? If demand weakens while issuance stays heavy, term premium can rise. That tightens financial conditions across the system. Higher yields do not cause collapse by themselves. They increase refinancing stress and multiple compression risk. That is how Phase 2 pressure builds. The video treats this as an immediate currency crisis. Our strategy treats it as a probability shift. Sequence matters more than speed. First comes yield pressure, then credit stress. Labor confirms later. Refinance-dependent balance sheets feel this first. Private credit edges and commercial real estate follow. Equity leadership weakens before the broad market. We watch treasury auctions. We watch term premium behavior. We watch repo and funding stability. This signal increases Phase 2 probability. If credit spreads widen, Phase 3 probability rises. Policy response comes after stress, not before. Quick note, this is educational macro analysis only, not financial advice. We assign more weight to duration clearing risk. China selling acts as a multiplier, not as a standalone trigger. We do not assume dollar collapse on a timeline. We do not skip confirmation signals. Plumbing comes before conclusions. Near-term continuation still has probability. But tightening risk is higher if yields stay elevated. That is a density shift, not a certainty. Credit becomes the swing factor. Widening spreads change the phase map quickly. This is where monitoring matters. Longer horizons raise policy response probability, not because collapse is guaranteed, but because systems stabilize stress with liquidity. We preserve optionality, we wait for mechanical confirmation, we prepare for forced liquidity windows. Strong auctions reduce this risk. Stable funding reduces this risk. Improving breadth reduces this risk. We do not need to be early. We just cannot afford to be late. That is our strategy.